All right, everyone, welcome back to another weekly roundup edition of On the Margin. Today, I'm joined, as always, by my magnificent co-host, Mr. Mark Yusko. And we also have James Davolos, who's a friend of Blockworks and works at Horizon Kinetics. I think, James, this is your first time on the show, but welcome.
Thanks so much for having me. I've been a big fan of your guys for a long time.
Now, great to have you here, James. And I'll do a quick reveal. You know, I appreciate the adjective, but I have the magnificent Bitcoin bull socks on today. Clearly, spring has sprung. Things are good. We're going to talk about macro today, though. So we won't talk about Bitcoin, but I am on my Bitcoin Friday pants with the orange going. So all good.
Nice.
Then I got the Carolina blue on top because I'm going to the bench seat dinner tonight with the team, even though we're not doing that well this year. But maybe we'll have a stretch run that's good.
We've got our fingers crossed for you, Mark. We've got our fingers crossed. All right. So maybe I'm going to turn it over to James here to kind of kick things off. James, you were listening to our show last week with Mark and had some sort of thoughts on our position on inflation going into 2023 and beyond.
Oh, let's say it what it is, Michael. He just vehemently disagreed and came out and said, hey, can I come on the show and disagree with, Mark, because he's just wrong. Yes. Because remember, if two people always have the same opinion, one is unnecessary. So we'll have to have my favorite thing, dialogue and debate in search of truth.
All right. I love it. Let's so James, with that introduction, I'll turn it over to you, my friend. What do you think?
So my way of describing it is a nuance to our views that are slightly divergent, but maybe
very politically correct.
But
very deferent. I appreciate that.
So Murray Stahl, our CIO, he was really early to recognizing inflation. So pre-pandemic, actually, where he noticed, okay, money supply back then, M2 was growing 6 or 7% a year. Rates were effectively zero. So you kind of see that, Friedman-esque money supply component, but we're not getting any inflation. But from a bottom-up basis, we also recognize that we were underinvesting radically in a lot of raw materials that are absolutely vital to how the economy functions. So you got a slow burn in something that's going to create demand, and then you have this nearly critical insufficiency in spending for supply. So all of a sudden, pandemic hits, and you basically dump gasoline on a slow burning fire. M2 grows, I think 40% year over year was the top number. Inflation spikes. We actually launched a fund in early 21. We were actually trying to launch it in 2020, but we couldn't get all the regulatory things done. An inflation beneficiaries fund. CPI, I think, was still under 2. And we basically spent an entire year arguing with people, look, inflation is coming. Don't you see what's happening right now? Inflation came, and some people finally agreed with us, but now then we kind of had the whole argument with the transitory crowd. And now we're kind of saying, look, we think that, yes, it's going to moderate, but you really need to think about I think two things need to be discussed. One, what is transitory? And then number two is kind of what is the trajectory of different components of inflation look like going forward from here? So first and foremost,
James, let me come in for 1 second and kind of set a stage here. Because I do want to have the debate and healthy debate on kind of future, but I hear you. And look, Murray, I'm a worshiper. He's one of the very best of the best. So I hate to disagree with Murray. I hate to disagree with you, but I will argue, and I've been arguing, there is no inflation. Everyone keeps talking about inflation. There's no inflation. There is monetary devaluation. And to your point, we went from this normalized 6-7%, not normalized. It was like the fastest money supply growth in decades, but no inflation, no CPI inflation. Well, right. The only reason we had CPI rise, remember CPI is a lagging indicator. It lags by about 16 months. The only reason it went up is because oil prices trebled from 40 to 120, and used car prices doubled because you couldn't get chips. So now both of those components have vanished. Oil prices are actually down year over year. used car prices are down year over year. And actually, they're down 43% in the last 3 months. Still up over 2 years ago, but they're down. And so, to me, inflation is when there's excess demand for limited supply. That is not what happened, right? We just printed so much money that the value of it went away. I mean, I got dinner last night, 2 little tiny pizzas and a few chicken wings, $44. That's not, those chickens aren't better. That pizza is actually smaller. That's shrinkflation. That's not inflation. That is, my money has been devalued. So that's the premise that I want. We can move past that, but that's where I come at it. That I just don't believe the word inflation is applicable.
And I think I'm glad you brought this up, because I think that's why there's a definitional divide here. Where you have two camps: transitory saying I'm right, and then structural saying I'm right. Because I think they're arguing two completely different points. The kind of the academic framework that you're talking about, absolutely, there's not inflation from the textbook standpoint. And people are saying transitory, there's no inflation, but these are the same people that were saying, buy 2-year and 10-year bonds when yields were 1.5, 1.25. Look, you can't say you're right. Like, everyone in this business gets a lot of things wrong. I'm going to go off on a tangent here. I hate the argument that everyone I'm trying to get 50% right. You're trying to get it, better than 50%, but the only way you make money batting 50-50 is either when you're right, you're really right, and when you're wrong, you're not that wrong, or you manage your positions really well when you're right versus when you're wrong. So everyone gets things wrong, but I think...
Well, but James, to that point, most of the people on Wall Street would have a massive celebration party if they could be 50%.
Yeah,
the
right.
average analyst on Wall Street is right 40% of the time. I can be right 50% with a coin.
Yeah.
These guys are making millions of dollars. And the Fed, this is my favorite, the Fed, which is chock full of PhDs, is over. They've predicted GDP and inflation 247 times, I think we're up to now. Over. Like, that's not possible unless you're trying to be wrong. Even then, you should get it right occasionally. But to be over is staggering. So I would say the 50-50, right? It's just back to the famous, Soros quote that Druckenmiller stole, but everyone says Druck, but it's Soros, right? It's not whether you're right or wrong. It's how much money you make when you're right and how much money you lose when you're wrong. So
exactly,
I don't disagree with you. We should always aspire to be right. That would be good. The challenge is it's hard, particularly in a world where things change and things get manipulated. But yeah, people who said buy bonds at zero interest rates can't rationalize away what has happened with the reset. And and look, I was one of them. I thought no chance, zero. I thought zero chance, which clearly wrong, that they'd raise 10 times, right? 10, 25 basis point hikes. Clearly that was wrong.
But I mean, this better than anybody. Those people aren't paid to be right. They're paid to get people to invest.
Amen. James, yeah. You're wise beyond your years.
Murray has made me cynical at the ripe age of 39.
That's impressive. And it's absolutely true, yeah. Right? I mean, what I always used to love is there was one firm, I won't name them, but they had one strategist who was always bullish, one strategist who was always bearish, and one guy who flip-flopped all the time, so he could say he was right, and he would just follow the trend, ex post, not ex ante. But yeah, they're definitely trying to sell stuff. And but I guess the real point here is, as you said, we should aspire to be right? We should do the work and we should try to be right. And there's no chance any of us, and I said myself included, who didn't think there was any way they'd raise rates 10 times last year, 25 basis point hikes. There's no way you're right if you look at the great reset in rates. But again, I will argue that great reset in rates it didn't cause the inflation. I would say that, the lowering of rates didn't cause the inflation. The raising of rates didn't stymie inflation. That's just my view.
You just brought up another great point I want to touch on, but if we look at it from instead of looking at the rate of change, CPI right now, just a raw measure, we're not seasonally adjusting. We're just taking CPI today versus CPI pre-pandemic. Price levels are up about 16%. So even if we flatline, you still have almost 20% higher input costs that companies have to deal with in terms of their profit margins. And anyone who is trying to cut costs right now realizes it's really hard to tell somebody who you gave a raise during the pandemic, hey, I'm actually clawing that back. Or a supplier like those pizzas and chicken wings. Those suppliers are loath to then reset prices, even if, maybe their procurement costs have gone down, but the truckers haven't gone down, their insurance premiums haven't gone down. And so this is what we're really focused on, is that the level is much higher, even if the rate of change is going to moderate. And that is going to have a profound impact on a lot of companies, a lot of individuals, and the economy writ large. I think kind of also when you look at it, there's two things that we really need to break down is, okay, there's cyclical inflation drivers and then there's structural. So within the cyclical drivers, 100% right. There was a shortage of cars, but there's no inability to produce cars. So there's plenty of used cars now in the market and prices are normalizing, probably going to go down a lot further, especially if a online car dealer that will remain nameless has to liquidate its inventory. Semiconductors.
Yes.
What could that be?
Something about Nirvana. Something like Nirvana. Something like that.
So, semiconductors. There was a shortage. This actually played into cars. There's plenty of capacity. Now we're making more semis. Capital goods. I moved to the suburbs during the pandemic, and God bless you if you're trying to build a pool, buy a refrigerator, get a countertop, put new windows in. There's no structural limitation to that. There was a surge in demand, and that has all moderated. So that's cyclical. That's in CPI. That's going to normalize, and that's going to moderate. The structural things are what we're more focused on, where copper, for example. So copper is in almost everything in the world today. So obviously, biggest uses are heavy construction, but it's in automobiles, it's in appliances, it's in the power grid. It's massively involved in wind, solar, EV charging. Even, fairly moderate estimates say, look, we're going to grow demand of copper by 80% over the next 20 years based on these factors plus organic growth. But no one's adding supply. And it takes 15 years for a new greenfield copper mine between permitting, assay, infrastructure, smelting, transportation. And that's the mismatch. And it's pretty profound in energy, in base metals, in agriculture, in fertilizer, because everybody, and this might be going on to another parallel here with ESG, but everybody believed that we can have this magical world where we don't need these things. So we stopped investing. But also capital markets, I believe in capitalism, and capital said, hey guys, you blew me up. I invested in copper, in iron, in fertilizer, in oil, in gas in 2005, 2006. Bricks are going to have demand forever. You guys got cheap capital. You flooded the world with capacity, and it took you 15 years to break even. So money's been withdrawn for 15 years. And this kind of goes to the, Ed Chancellor, Jeremy Hoskin capital cycle theory. Capital's been withdrawn, returns are now going back up, but now the capital's not coming back in. So we think this structural inflation is going to be around on a secular basis, meaning years, if not decades, regardless of what those cyclical drivers do. And I think that that's going to be really important for thinking about how the economy is going to work, corporate profits, and then even individual balance sheets, let alone the federal balance sheet, which again is a whole other can of worms.
One more point about just structural inflation, then Mark, I want to get your response here. The other driver when I think about, we've talked about borrowing from low cost labor pools like China, et cetera, but like even leaving aside that for a second, one other, when I kind of think about structural drivers of inflation is just literally if you just look at debt to GDP. Mark, you and I have talked about this on the show. James, you brought this up actually when we were talking before. The CBO, Congressional Budget Office, they project $1.6 trillion worth of deficit for the next 10 years, right? Unless there's going to be, and no one has any plans to pay that back, right? You don't see one politician talking about austerity or any way. And the only way that you can do, you have, Mark, you've mentioned this multiple times. There are a set number of options that you have as a country, right? And yeah, 4 options. The most likely of that to me, right? The easiest is the soft default through inflation. So that doesn't get listed a lot of times as like a driver of inflation necessarily, but you have to imagine there are at least some smart policymakers that are sort of thinking, hey, inflation actually wouldn't be the worst thing in the world because we've got this enormous looming problem in the form of debt. So I just wanted to add that to the list. And Mark, get your response to all
although,
that.
you know, it's interesting. I do say that, right? You can pay the debt back. Never going to happen, right? You could tax all of the assets of all the people in the country. Forget their income. Just tax all their assets. Can't pay the debt back. Okay, so you can't pay it back. Restructure. Problem is you got to take someone to take the other side. You got to have someone take the other side. People are dumping the bonds; they're not buying them, so that's not going to happen. You can default. Unless you're a dictator in a small foreign country, you don't default. So Western governments don't default on their debt. Because then you get kicked out of office. And turns out politicians like to stay in office. I don't know if you've noticed that trend, but that's a really interesting trend. And now we got a lot of octogenarian politicians, or at least septuagenarian. So, well, I shouldn't make fun of those since I'm about to become a sexagenarian. That's a funny word, sexagenarian in May. But you know, the fourth option of soft default through inflation. There is another option, and it literally just hit me as you were talking, Michael, that Kyle Bass, who's a friend and has been screaming, right, for more than a decade, that Japan had this problem, right? Massive debt, massive deficits, budget doesn't balance, therefore their debt has got to collapse, and then, you know, interest has got, you know, they got to deflate or devalue their way out. But they've had no inflation, literally no inflation, like none, zero for 2.5 decades. Why? Well, because it turns out the central bank can just buy all the bonds, and then it becomes self-owned, and you do a reset. And that's what's coming. You know, that's why QE is happening. The Bank of Japan just did the largest QE in over a decade. No one's talking about it, right? The yen went from 150 something to 128. I mean, they injected more, and China is QEing, right? Not talking about it, but their credit impulse has gone up. So the amount of money printing that is coming to, and the thing about that is, that should do all the things that James just outlined in terms of structural increase in prices. But then you throw on top of it the demographic problem. And, you know, somebody sent out a chart the other day that industrial production in the United States has been dead flat for almost 15 years. And I was like, what? It's shocking to you that 65 to 85-year-old people are not as productive as 45 to 55-year-old people? That's a surprise. I mean, they're perfectly nice people. Don't get me wrong. I'm not bashing on seniors, right? I'll be one, you know, sooner than you guys. But they're not productive, and they will never be productive, and they don't spend as much, and they don't buy as much, and they don't work as much, and it's a really interesting phenomenon when you look at industrial production flat, like no growth, no, and this is not even, you know, it's kind of like retail sales, right? The data is even bad. Retail sales doesn't adjust for population growth. What do you mean? How can you do that? Well, of course, retail sales go up if there's more people. Oh, well, we don't adjust for that. Or when they do retail sales and they use gasoline prices go up because oil prices go up, and they say retail sales went up. People didn't buy more gasoline. They bought less at a higher price. That's not increased demand. Anyway, I digress.
But yeah, Mike, to your point, the the deficit and the current debt to GDP. The people that think we can magically grow our way out of it and pay back the debt like the post-World War II era. You need massive workforce growth and or massive productivity growth, which I would argue are almost impossible, if not impossible. But here's
impossible.
Yeah,
I second that emotion.
Here's a good data point. In 1999, where the internet was just becoming useful, instead of just like people like buzzing around on Netscape and AOL Messenger, it was becoming actually useful for businesses. Over the ensuing 20 years through 2010, productivity, so output per labor hour, grew 36% in aggregate for a 3.2% CAGR. So that's 320 basis points of tailwind to GDP growth from productivity from this thing called the internet. Unless you know of another internet that's going to come around in the next couple of years, that productivity is not happening again. Labor force, demographics, it's simple math. That's not going to happen. So we can't pay back the debt. It's a fact. So inflate is the easiest option from a politician standpoint. No one's going to say, look, I'm going to spend less from a fiscal basis. So that's, I think, the end game. And if you believe in that end game, I think that obviously Bitcoin has a very, very high allure to you if you understand those dynamics long term and can just stomach the volatility as all this stuff gets kind of processed through the system today. But kind of going back to other structural factors, people in this business love to look at the past and then extrapolate it into the future as if it's going to be like a fact. So, okay, 5-year back test, 10-year back test, 20-year back test, this is going to happen in the future. Almost every single one of these strategies that's based on a back test, the second it goes live, it breaks the trend. But Steve Bregman wrote a commentary for Horizon that touches on this. What if the last 10, 20, 30 years was actually the anomaly and today's going back to a more normalization? So what are those trends that were anomalies? One, globalization. We had a huge wave of globalization over the past 30 years, which gave us disinflationary forces from cheap labor, cheap commodities, and efficiencies of global trade and supply chains. All of that's ending or reversing today. We're onshoring to make businesses more resilient as opposed to more efficient. We're competing with non-OECD countries for commodities because we're exiting an era of abundance, entering an era of scarcity, and we're competing with them for labor, where their labor cost is actually going up and they want it for domestic uses. You kind of add on top of that productivity, which has been disinflationary for 30 years, certainly the last 20 with the advent of the internet. And all of these things kind of added to this era of declining interest rates, rising profit margins, compressing risk premium, and basically every risk asset just went straight up for 20 to, not straight up, but you see the point I'm saying. And bonds went almost straight up because interest rates went down for almost that entire period. We think that's the anomaly. And now we're going back to a more normal world, a normal economy where inflation is going to be higher, albeit volatile, and profit margins are going to be rewarded to very good business models and very good assets, not just somebody who can raise money at 2% and then allocate it at 5% and have a company.
What's going on, guys? Want to give a quick shout out to this episode's sponsor, Curve. They are the one-stop shop credit cards that helps you take control of your personal finances. Here's the reason that I personally love this company. These guys are all about helping you manage and maximize your personal cash flow. We have been talking for the last couple months about everything that the Fed is doing with raising interest rates. Obviously, no one's got a crystal ball. This is not financial advice, but I think it makes sense more than ever now for companies to be managing their cash flow and for you as an individual to be managing your personal cash flow as well. Curve makes it super, super easy to do that. Even I can do it as a technological Philistine. They aggregate all of your spending information in one place. They make it super easy to plan. But they actually go one step further than that. They have a very cool feature called Go Back in Time, which allows you to switch payments from one card to another. So if you have an unexpected expense crop up, boom, you can move that over to your credit card, free up some cash. Or maybe you learned too late that you could have earned more rewards by spending on a different card. Boom, Curve has you covered there too. And the last thing that I'll say is, if you click the link at the bottom of this episode, you'll get $20 in Curve cash, but you'll only get that if you click the vanity link at the bottom of this episode Plus, that gives me the credit as well. So thank you, Curve. I appreciate you caring about cash flow. Guys, click the link at the bottom of this episode. Tell them I sent you. I want to make the point, just to build on, I think, something both of you are saying. And actually, we had Michael Cow came on the show to do an interview this week. And his framework for inflation it kind of dovetails with everything that we're saying now, which is his position was that kind of we were short globally energy. And that was a huge, that was what kind of kicked off inflation, right? Because we basically had an enormous amount of demand come back online. We couldn't meet the supply. And that the inflation started with energy, but then it leapt over to stickier components of CPI. And one thing, Mark, you and I we were looking at, because CPI print came out last week, and we were kind of dissecting like goods versus services inflation. And you can see goods inflation, everything, James, you were saying about cyclical moderation, like used car prices are going down, everything's kind of going down. But what's extremely sticky is the services part of inflation. And I know a lot of that is shelter, and that's going to lag, but there's still the wage, part of that, which is basically core services x shelter is still, extremely sticky. And that's the part that's like harder to measure, because like this psychology of inflation is still here, I think.
Yeah, the shelter one, ugly. It's going to be ugly. And look, we talked about it. According to Zillow, the house I sit in Chapel Hill went up 40% over 12 months, and my house didn't grow. It didn't get more efficient. I say the same thing every time. It's going the other way, and it's not. And housing prices aren't going down 2%, 3%, 5%. They're going to go down. Heard it here first. 40 to 50%. We're going to see one of the most massive corrections in housing because of what happened to interest rates. And so here's the interesting dynamic. So interest costs on government debt have never, let that sink in, never, right? We've been a republic for a long time. We've had debt for a long time, have never been more than 3.2% of the budget. I'm sorry, 3.2% of GDP, not the budget, 3.2% of GDP. Never. They troughed a couple of years ago at 1.2, something like that. It was 1.3. We are rapidly heading back and closing in on 3.2. It doesn't work, right? So the challenge for all of us is this idea that, you had the cult of Kelton come in and say, you can spend as much as you want, deficits don't matter, just print the money and it'll be fine. And they use this analogy of a sink, right? You put the stopper in the bottom and you fill it up with new money, and if inflation gets out of control, you just remove the stopper and drain some of the liquidity. Okay, that's a great idea, except those government bonds, I think it's 47, doesn't really matter, but call it half of the government bonds are sub 1 year in duration. Okay, so all of those are ratcheting from onesies and twosies to threesies and foursies and fivesies. What does that do to the deficit? Makes it go up. What does it do to the ability to print more money? Probably restricts it. So I struggle with that, which is certainly, I would say, a restrictive force for rising rates. Because if you think about it, if I have to issue more bonds because my deficit's bigger, what should I have to do to interest rates to entice buyers? I would have to raise them. But Rob Arnott writes on this, and I don't know if we would have Rob on because he's just too smart. I don't like to be able to say, you guys are smart, but he's just like way too smart. I don't like to be on the same show as him. But I'm just kidding around. But Rob is really smart, and he writes about this, that he didn't think that's going to happen, because the challenge for me on all of this inflation talk is there's two trends that are, I won't say perfect, but statistically they're perfect, which is working age population growth and interest rates. Okay. Working age population growth and interest rates are perfectly correlated. And when working age population growth was rising in the 70s, when all the people that came back from the war were reaching that perfect working age, and it's not just working age like 25, you go to work, but it's that 45 to 65-year-old, really productive, really, firing on all cylinders, consumer, and interest rates went up. Since then, since the early 80s, working age population growth has been in decline, and it's accelerating, right? Working age population growth over the next 20 years is going to trough at close to zero, right? So, and GDP is equal to working age population growth plus productivity. So absent what James talks about, some 3% tailwind to, like is Web3 going to be as big for a tailwind as Web 1 and Web 2? Tough, maybe, but tough. So absent that, we're going to have sub 2% GDP growth for a long time. And then here's the kicker. What Rob says is the reason you're not going to see interest rates continue up is 65 to 85-year-old people don't buy stocks. They buy bonds. And so you won't have to raise rates to attract buyers because everybody is going to be cashing, and they're going to be forced to cash out. Like I think last year, no, it was 2 years ago. 2 years ago, net was the first time since 1986 when they passed the law that the demographics, we got to 71 and a half. And so every single day, right, for the next 17 years, a whole cohort of people are going to turn 71 and a half is when you're forced to take money out of your IRA as opposed to put it in. So there's going to be net outflows of stocks, net inflows into bonds, and that's going to put continuing pressure on rates. So that's the only part that I struggle with is demographics are destiny. No chance we can change the working age population growth. Can't even fix it with them. We could open up the borders, which we should. And like we should send planes to India and China to the best universities and get all their PhDs to come live here and work here and grow businesses. But we're not going to do that. But I don't know. I don't see how we get out of the demographic destiny of rapidly declining productivity and working age population growth, therefore GDP and rates.
I mean, yeah, I don't think that anyone can really tell with any certainty yet, but there's an argument that the demographic bomb, which is a fact, would actually be inflationary as there's less labor and less labor productivity, which kind of plays back into this margin compression story. So, I mean, that's a tough one. And I think that's going to be one of these known unknowns that people are going to have to keep a really close eye on. But I actually want to touch on the comments you made on real estate, because we knew a month or two ago that the Blackstone REIT gated redemptions. Yesterday, we found out Starwood gated, and we found out KKR gated. So we have a bridge lending team at Horizon. They have a small fund, really interesting. But so then they're down in Miami at a multifamily conference earlier this month. So I had no idea people were playing this game. So what people were doing is they were going out and buying a multifamily property anywhere from a 3 to a 4, maybe max a 5 cap, but let's say 3 to 4 during peak free money. They're borrowing at SOFR plus 200. So let's say they were borrowing at 2.5. And banks, multifamily is impregnable. So I'm going to give you an 80% LTV. So they've got an 80% LTV interest only loan at 2.5 floating, and their property's yielding, let's be generous and say 3.5. So the game that everyone was playing was, I've got this 2 to 3 year IO loan. I'm going to go in, I'm going to paint the building, I'm going to put in a new refrigerator, and I'm going to put carpet in, and I'm going to raise the rents. Then I'm going to have higher net operating income. I'm going to basically go to a bank and get permanent financing off of my higher NOI, pull out my equity, and now I have all this cash flow for free. And rinse, wash, repeat. People got really rich doing it. But when the music stops, you have a big problem because, oh no, SOFR is now, what's 1 year? 3.5, 4, plus 200. So now you're carrying a property yielding 3 and change at 6 and change. And you have basically this liquidity mismatch. And then this is what really terrified me. Everybody at this conference is running around to bridge lenders saying, hey, I need 1 year extension. It's like, okay, well, what's 1 year? What's a 1 year extension going to do? I don't know. The Fed's gonna pivot in the back half of this year. So just give me a 1 year extension, bridge me for a year. SOFR's going to go down and it's all going to bail me out and everything's going to be fine. That is happening with these smaller people that are doing this rinse, wash, repeat. But it's also happening at the biggest levered private equity firms in the country with this multifamily thing. And it's just like, where like 4.5 caps in this environment when your funding costs might be 6.5, 7. So like, I had no idea this was going on to the extent it was going on. And now seeing that these redemptions are being capped everywhere makes me think like, wow, could this be the Bear Stearns credit funds in the spring of 2007? I hope not.
Yes. No. Look, and that spring of 2007. And it's so funny listening to you talk about this because it's just a different version of. Yes, it's actually kind of why I'm sitting here today. I mean, Morgan Creek would be nothing really if not for that 2006 2007 period where we just got that right. You know, there's this funny line that when people would leave Julian's shop, and Julian was my mentor when I worked at UNC, and people would leave and he'd say, Julian, do you have any advice for me as I start my new business? He'd say, yeah, make sure in the first 2 years you get lucky. That's really good advice, really hard to follow. But it took us 3. So we launched in 2004 and you know, I've told the story. So we had this client, he founded J. Crew, sold it to TPG, retired with $300 million. He moved to Incline Village. Well, he moved to Incline Village first, then sold the business so he could get the tax break and bought this big house. And we're talking to him. And he was 83 years old, quoted Sartre, great guy. He passed away finally, but amazing guy. And he calls us one day. And he was madder than a wet hen. I mean, he was pissed. I'm like, Arthur, what is wrong? He says, I deserve to live here. I'm like, well, of course you do. What are you talking about? He says, I sold my business for $300 million. I bought this house. The average house in Incline Village is $12 million. I deserve to live here. The guys on either side of me, 35 years old, 2 kids. There's no way they can afford to own these houses. This ends badly. You find me a way to get short.
Wow.
I'm like, okay. And we went out and we met John Paulson and John Burbank and Kyle Bass. And we put 10% of our client assets with 6 different managers who were all short subprime. In 2006, first month, we gave the money to John. You remember the movie? You remember the scene in the movie where the bankers are saying, "Oh, we got this." Down 13%. We're down 13% in the first month. Clients tearing their hair out, thinking you guys are so idiotic, right? This is going on forever. Now the rest is history, and John was up 500 and something percent, and life was good. But the point was, I had a friend, right, who was condo flipping in Miami. Kind of same thing, right? He had 20 condos. Bear Stearns happens. He puts them out for sale. He says, I'm gonna do a 50% off sale. No bids.
Oof.
Not no offers. I mean, not no sales, no offers, no nothing. And they all got foreclosed and the banks bought. Now, all those condos have been sold. If you go down to Miami, everybody's, living large, but it took a decade. And exactly what James described, it's coming. You look all around Chapel Hill, North Carolina, where I live. There are driver 9-iron. Well, not my driver 9-iron, but driver 9-iron for me. There are 20 apartment things that all happen with this special opportunity zone thing, this nonsense where, rich people got a tax credit for, backing an apartment complex. So many apartment complexes, empty.
Yeah. The opportunity zone thing was, people love to point to PPP as a form of grift. I would love it if someone did an analysis of opportunity zones and who actually
they did the whole episode of Billions. There was 3 episodes of Billions where they went down and told you, this is total grift for billionaires. I mean, Crazy. An investigative reporter could win a Pulitzer for that, probably.
So just to put a bookend here on what you guys are saying, is there's still risk in the real estate market, and a lot of people, we've talked about on the show in the context of sort of single family real estate, basically like people's homes and stuff like that. But I honestly I kind of skimmed the headlines for BREIT. I saw KKR. There was a similar situation, and so what type of is that commercial real estate that's impacting? And then like, what are the overall implications of that, right? Like the scary part, right? Basically my takeaway, James, from what you were just saying, and you, Mark, is basically there's real estate is extremely interest rate sensitive. We had extraordinarily low interest rates that a bunch of enormous, real estate managers levered themselves to. And now that rates are up, potentially they might have to liquidate holdings or they're in trouble, and everyone's counting on a pivot in 2020. Is that the basic gist of what we're talking about? It's like, what are the implications of if we don't get a pivot? Are these guys all underwater? And if so, like, what happens in that situation?
Remember that picture of Mr. T? Pain. 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 Yeah. And I know most people listening to this are like, Mr. T, who's Mr. T? Google it. Mr. T, amazing actor.
But Mike, to your
in air quotes.
To your direct, I know Blackstone's portfolio is mostly multifamily, and they're in the Sun Belt, where they tell you all these reasons why it's advantaged, and they're really smart, really good real estate investors. I bet that their properties are much better than your average apartment building, but gravity is gravity. I'm not sure what Starwood and KKR's portfolios look like, but the real pain that this bridge lender was seeing was focused in multifamily. But to your point, and there's parallel to this with, okay, what is inflation? What is a pivot? So a pivot where they pause, these guys are still toast because they're done with a pause.
Say that again, James. Say that again. Because that's the point that people have to realize.
A pause, everyone is still toast in the back half of this year.
Yeah,
that's what no one gets.
Can you explain that to me?
So, okay, what is a pivot? In my mind, a pivot means, oh my gosh, the system is collapsing. We've got to cut. I think what's more likely going to happen, and Neil Kashari wrote a op-ed on his Medium blog, which basically said, we're going to get another one or two in, and then we're going to pause for an extended period of time, hire for longer, and wait for it to flow through the system.
So you're the one reader of that blog. I'm so psyched to meet you. That is so cool.
I'm just like, because somebody sent it to me, and I'm just like, the guy who was saying we need to stay at 0 through 24 or whatever he was saying before is now saying, I got to at least see what he's saying. He talks about like Uber surge pricing. I was like, all right, anyway. But that is doomsday, because a pause at these rates, everything still breaks, and everyone's banking on materially lower rates and materially looser policy in the back half of this year. But let's just assume you're borrowing at SOFR plus 250, your funding costs are 6.5, and you're in a property yielding 4. If they simply pause, you're not bailed out in the back half of this year. You're still underwater, and then good luck finding someone to extend that for another year.
Yeah, the extend and pretend, it's just not going to happen. And I mean, it'll happen with some, right? Like if you're a friend of Jamie Dimon, you'll get an extend and pretend, fine. Mm-hmm. So some of those guys, look, Barry has lots of friends in high places. He's actually one of the smartest guys I've ever met, Barry, at Starwood. But and his partner Jay Sugarman, definitely one of the 5.
So we're talking about Barry Silbert there for a second.
I was like, you got to clarify on this podcast.
I feel for Silbert. I do. I mean, visionary, early, but no. Barry Sternlicht, definitely one of the smartest people I've ever met. But his partner Jay Sugarman, even smarter. I mean, like super smart. But even those guys don't have an answer for what James just described. A pause is not a pivot, and it'll get hyped up in the press that that's a pivot, but it's not. And stocks in a short period of time might rally. So what's interesting about this is while while James and I differ on kind of this construct of inflation and what it means, we are in violent agreement on the impact of structurally higher costs. And I will argue it's just a devaluation of the currency as opposed to inflation, but that's just semantics, actually. But structurally higher costs will compress margins. Falling demand from this demographic time bomb will depress profits. This deglobalization, let's hope that the Websters don't get the depopulation they want. So the deglobalization is bad enough, but the depopulation is worse. But all of that says the people who want to hope, like Bed Bath & Beyond was up like 100%, and GameStop was up 80%, and my favorite one to pick on, Peloton, right, was up 80% in 5 trading days. Oh, because the bull market's back. It ain't back. It ain't back.
I've got a our newsletter writer Byron I stepped in for him one day this week, and I'd love to get we're talking about this sort of shift in environment secularly, right? Where there are these there's very slow growth, very deflationary environment for a long period of time, and that allowed the Fed to basically, continue to lower interest rates and step in whenever there was sort of trouble in the market. And that's what gave rise to this idea of the Fed put, right? And that's frankly what we're watching still play out, right? At the highest, most sophisticated level of investors in the United States. One, with the return of inflation, is it possible that we've seen that dynamic shift? And there's actually for a long time, it's bad news equals good news. Well, now it seems like this could be a good news equals bad news type environment, right? Where Powell's extremely concerned with the labor market. He wants stocks to go down. So whenever there's a bit of good news, right, or bad, the stocks go up, and ultimately that paradoxically is bad news, right? Because when Powell sees stocks going up, my interpretation of that is okay, I've still got room to run. I've still got leeway to continue to be more hawkish, right? Because, stocks going up on bad news is signs that I haven't finished my work here. Do you guys, and that's almost like we've replaced a Fed put with a cap on asset prices. What do you guys think about that theory? Is there water there, or is that not how you think it works?
I think it's really complicated, but obviously Powell obviously needs to see inflation come down for political reasons, for legacy reasons. If you're looking forward, like Mark brought up before, owner's equivalent rent. They know it's a trailing measure. They know all these softening data points. Some people are jawboning about it, but they also, I think part of the mandate is to not let the profitless tech basket just rip again. I think those animal spirits do have to be crushed, but there's just a big, there's very little they can do here about the bigger problem. There's almost nothing they can do, but they're not doing it. So everything that they're doing is around suppressing asset prices and ultimately suppressing demand. That's a Band-Aid. A surgical fix to the problem is get us more labor that's productive, get us more oil, get us more gas, get us more copper, get us more food. We are doing nothing to solve the supply side. All we're doing is a Band-Aid to try to fix short-term demand. So what does that mean? There's going to be something that cracks in the system. I don't know what it is. I don't know when it will be. Personally, I'm shocked that nothing has, quote, broken yet. I was in Mark's camp. I said, there's no way we're getting in all these hikes. I would have thought something would have just completely crumbled, but maybe there's a lag. And I think maybe you're seeing that in the multifamily market. But lo and behold, something's going to happen. They're going to have to ease because they can't let credit go. The lesson everyone learned in 08, 09, they don't care if tech stocks go to zero. But once you start seeing solvency, they're like, wow, this can spiral and waterfall really fast. The banks are fortresses today, but who knows where? Does the shadow banking system have that? Is it insurers? I don't know. But when that happens, they're going to have to ease again. And then when that happens, I think you get a much more violent second wave of inflation. And that's just where public policy is. And, Mark, you mentioned the smartest people in the room, but One of the people that I'm just awed by is John Arnold of Centaurus Partners. So for people that aren't aware, he's probably the most prolific natural gas trader of all time. And gas trading is highly, I'd call it scientific, because you're looking at injections, you're looking at withdrawals, you're looking at weather patterns, you're looking at exports. Like they have satellite data looking at Freeport LNG. But this was years ago where John realized prices were too high. A hedge fund up here in New York and Connecticut was betting on spreads between injection season in the summer and then drawing season in the winter. John's like, no way. Made billions of dollars. This hedge fund collapsed. Like, guy's brilliant. He was quoted in the Financial Times and he said, what if, just what if, the past 30 years of globalization and productivity gains and all these other variables that were disinflationary allowed this wildly irresponsible fiscal policy to not be inflationary, and that's not happening anymore.
Yep. No, and to this point, John is definitely one of the 5 smartest people I've ever met. He was a client for many years, and I have a great story about this. So, he was the guy that actually made money at Enron. Everything else was fake, but John crushed it, and it was definitely scientific. But he also had some edges. My big thing is edge. #edge. John had an edge. I think I have this right. His college roommate or college friend actually ran the Henry Hub. And so John could call him and actually find out what was happening with flows and injections. But he was maybe the greatest commodities trader of all time. And there have been some great commodity traders, but John, created a $6 billion fortune in a short period of time and now has a great foundation, and John's great. But it's funny, on the day before that other guy, so there's this, famous guy, New York hedge fund, I'm sitting with John in Houston. And I said, how you doing? He says, it's the happiest day of my life. I'm like, why? I'm like, why? And he says, the anglerfish? I'm like, yeah. You mean the thing that, it's got the thing on its head? And yep, that's me. I got this guy. And I'm just sitting there with my mouth wide open, and he's coming and he's biting at my thing, and I'm going to eat him. And the next day, $2 billion. He made $2 billion the next day. It was in the paper. This guy went out of business. He had to resign. They had to shut down the hedge fund. I'm like, the anglerfish. And what's great about John is you could pitch anything to this guy. Anything at all. The most esoteric strategy. And before you finish the description, he would ask you the hardest question that challenged your thesis. I'm like, how can you don't know anything about that. No, because his brain just works exactly as James described. He thinks about the linkages of a process, reverse engineers it in real time. And so what if you change one of those variables? And that is how great investors really do it. But we can't all do that. But he, again, truly dazzling.
And remember, everyone.
More, James. We hang out with all the, other than Cash Carey, who I don't think if I'd ever read him, but we hang out with. You get to hang out with Murray all the time, which again makes me very jealous.
Remember, everyone said John couldn't make money if he left Enron.
Yeah. Yes.
But so I think to kind of put a bow on this,
compounded at 300% for the next 3 years.
Yeah.
Let that sink in. 300%.
I recommend everyone. He speaks very rarely, but I think there's one podcast he did with Chuck Yates. I recommend everyone listen to it. And then his business partner, Bill Perkins, where there's an incredible story about him buying the Sugar Shack painting at Sotheby's or Christie's, which is incredible. I recommend both podcasts. But to put a bow on this, the world that we all see, what do you own? And I think, based on kind of the end game, to kind of take the Grant Williams thesis here, I think you have to own hard assets. You have to own tangible, finite stores of value. What do we own? We own a lot of energy. We own a lot of precious metals, base metals, agriculture, land companies, things like that have this staying power, that have this value. And, this thesis, I think, is also very strong conclusion for Bitcoin as well.
Yeah. So, look, here's the great thing. So we can have disagreements, but then we end on this violent agreement. And I know we got to wrap because somebody's got a hard stop. But look, I talk about this all the time. In the kids' game, rock, paper, scissors, paper beats rock, right? Not in real life. In real life, rock beats paper. And that is going to be writ large over the next decade. Paper is going to burn, and rock. And look, rock, gold, metals, copper. They use 40 pounds of copper in a car. 40 pounds.
That's a lot.
I mean, that's a lot of copper. And the EV, it's probably even higher than 40. But it's huge. And so my thing is hashtag get real, assets that is, and rock beats paper. So those two themes, I think, will make people a lot of money. And the last one, back to the oil patch. Anyone who thinks, like, I think Kathy was quoted saying that oil demand was going to collapse to 70 million barrels a day by, I think she said 2030. I don't want to get it totally wrong, but maybe it's 2025, but I think it was 2030. We're at 101, projected to be 104. It ain't going to collapse. Every year, we have to discover a new Saudi Arabia. That's hard.
And now no one's giving anyone any money to do it.
Exactly. And so and that actually goes against everything I believe about actual inflation. So it's, point to James this morning.
Another example just about this capital cycle, and coal should not really be used anymore whatsoever. Gas plants.
Not ever.
Yeah. Gas is cheaper, it's more abundant, it's more efficient, and it's cleaner. But look up Newcastle coal prices, where Newcastle coal prices are still high. I mean, they were incredibly high over the past 2 years because these non-OECD countries, this is thermal coal, by the way, which is for power generation, which needs to be distinguished from metallurgical coal, which is used in steel making. But these people, India, Indonesia, China, non-OECD emerging countries, they need power, they need heat. And they are going to use the most abundant and cheapest way to do that. And so you're seeing new coal plants going on every day because it's reliable, it's abundant, and it's cheap-ish. And that's what's going to happen until we figure out a longer-term solution. So if we're still burning that much coal, the tail on oil and gas demand it's not even decades, it's centuries.
Yeah. And to that point, look, the worst thing you can do for human health is burn thermal coal. Burning thermal coal releases mercury into the air, which causes hard tumor cancers. If you draw a cloud around where coal-powered plants are, like the south end of Long Island, you've all seen those red and white 3 smokestacks, draw a cloud around that, 85% higher incidence of hard tumor cancers. Okay. Indiana, where I used to live, 85% higher incidence of hard tumor cancers. China, highest incidence of hard tumor cancers. And so the other thing you want to do, because we're not going to stop burning the coal because it's really cheap and governments don't give a crap about their people, is biotech. So you need the immunotherapy drugs, which can, and it's harder for hard tumor like breast cancer, brain tumors. But on the blood tumors, the immunotherapies are actually working. So biotech is a great pairing with those coal investments.
Can we've got to wrap here in a couple minutes, but I want to leave you guys with a statistic that will make you glad that we actually live, because sometimes this comes across a little negative and there are going to be all these problems. So I'm in Savannah, Georgia right now for our company offsite. We were doing a tour of Savannah's the most haunted city in America. And we did this tour. And one of the haunted buildings that we saw was a place where surgeries used to get done. You want to guess what the anesthetic that they used back around the time of the revolutionary kind of war, 17, 1800. Yeah, it was alcohol. It was awful. And actually, they would strap you in. So they take you to this house. They'd get you basically hammered. They'd strap you into leather. It was actually a form of entertainment for the townspeople. Townspeople would come and it would be like a party, and people would come down and watch the surgery. People didn't know that germs existed back then. So the sign of a good surgeon was a bunch of blood from old patients on their smock, white smock, no good, an inexperienced surgeon. You want to guess what the mortality rate was on surgery?
50.
I don't even want to know.
35% of people survived, and that was for a good doctor. That was not even the average. That was the doctor of this particular, which was a very good doctor. It was actually sub 30. Isn't that so? You know what? We live in actually a pretty good period of time.
Amen.
We
live best time to be alive in history until tomorrow, and tomorrow will be better. And that is why we Bitcoin. Throw that in there. But no, it's why. Again, sometimes this comes across as sinister Saturday, but it's not. It's spectacular Saturday. It's super Saturday. It is. The future is definitely bright, and the fact that we have, immunotherapy drugs that can solve cancers is amazing. The fact that we have anesthetic is amazing.
The thought, that's why the innovation thesis is so seductive, because humanity, America, capitalism, it's incredible. And it's one of the best things ever for all of our lives, all of our kids' lives, all of our grandkids' lives. So yeah, it's a very wonderful thing, but I think you have to look at what is the actual net benefit. So yeah, immunotherapy is I'm rooting wholeheartedly for all of that, but I also think that these profitless business models, that's not innovation. That's selling dollars for 50 cents was what essentially a lot of these businesses were doing.
Yeah, there's grift. Yeah. Look, 40% of Russell 2000 companies don't make money. They need to go away. And here's the thing. I will say the last thing on interest rates, zero interest rates and negative bond rates was a travesty. Capitalism, which is one of the great forces of mankind, right? Profit. It's not bad. It's not evil. It is good. Doesn't work with negative interest rates. It just doesn't. And the fact that there was $20 trillion of negative yielding bonds, which have now all been erased. So as painful as this readjustment is, but we have to remember why there were zero
in nominal terms, though. In real terms, a lot of them are still negative. Right? For bonds.
Yeah, that's a good point. That's a very good point. In some places, yeah, you still have negative real rates. That's right. But the bond yields themselves, the physical, there's an expectation that you'll be paid something if you loan someone your money.
Yeah.
The idea of giving your money to a government and paying them to hold it was insane, right? Or negative yields on bank savings accounts. But capitalism breaks down, and I'll argue it breaks down under 2%, forget negative. But having that incentive back, and look, we don't want 22% rates like the 70s. I don't think that's going to happen either. But what we need is this acknowledgement that capital today has value, and capital invested for tomorrow will have more value. And that's what we're back to. And as painful as it is for those punters buying those properties that James was talking about, they're going to die. The other area that we haven't talked about that we don't have time to talk about, talking about multifamily problems. How about office? I'm at 12% utilization, y'all. 12%. Most of my team doesn't want to come back to the office. So for the first time, we're thinking, do we break our lease? Do we renegotiate? I mean, that's a real, and we're not the only ones, right? There's a lot of office space that is never going to be utilized again.
Yeah. Hey guys, this has been a ton of fun. I'm really sorry. I've got to run here. But James, thank you for coming on the show. Mark, as always, best hour of my week. Thanks, guys.
Thank you very much. Safe flight, Mike.